Hey, welcome back to another week in review. Quint, new month. We're into March now. What's going on in the markets?
More of the same. Very, very difficult environment right now. Interesting, January, I think the S&P closed down over 5%. There was another 3% in February. We're starting off March, more of the same. I think, close to 2%. So we have this slow progression downward, and it's because of uncertainty. So we've talked about this with folks that markets are obviously controlled by stock prices. Stock prices are always tied towards profit, what a business makes, income versus outgo. And profit is typically generated by what management decides to do with their actions. When markets have uncertainty, and you filter all the way back up to the top, managers, CEOs, executives have a hard time making decisions. The irony is, even during periods of consternation when, we have COVID or we have war or something along those lines, executives can make decisions and they can plan accordingly. And so they either pull back or they move forward or whatever. And the market reacts to that very quickly, adjusts, and moves on. And that's why a lot of times there's an old adage in the market, buy the sizzle, sell the steak, or buy the rumor, sell the news. And what that means is that leading up to an event, there's uncertainty, and either things go up or things go down based on uncertainty or climbing a wall of worry or whatever. And then when the news hits or the certainty comes in play, there's usually an adverse reaction, up or down. And so the market right now is in complete uncertainty, even though we've had an invasion. And the irony is, the day Russia invaded, the futures were just getting crushed. And then, interestingly enough, the next several days it was up. We were off to the races. And I'll tell you why. Is the market, stocks, the participants really thought, and I think as the world did, Russia would move in to Ukraine, it would be over in a matter of days, and we'd go about our business. Whether, Europe or NATO or even Americans would like it or not, they thought this is just going to kind of move on and we're going to go about our business. Crimea was similar. I think it was good for maybe 1 or 2 days of market, volatility, and then we were back to normal.
Yeah.
Nobody cared. I believe the markets of the world thought that. So here we are, the market rebounds on that certainty of invasion. And then something happened. And that is, the Ukrainian people said, no, we're not going to just roll over. And so we've had complete, obviously, chaos, dramatic uncertainty. And now that we have more and more uncertainty in the environment that we're in, markets don't know how to handle that. Executives don't know how to handle that. And the reaction is selling and lower prices. And that's what we're seeing here.
Yeah.
The difficulty right now is we don't know the exposure of U.S. financial institutions or insurance companies or pension funds or anybody for that matter, what their exposure is to what's happening in Russia. So as you know, we've applied incredible amounts of sanctions, not just, on imports and trade and so forth, but financial sanctions. So we've basically crippled the Russian economy. The ruble has collapsed. Every publicly traded company in Russia and on our exchanges, if they're listed there, has absolutely collapsed. And that's having significant collateral damage. However, remember, we're a globally connected society. So we're trying to determine, we collective market participants are trying to determine what exposure U.S. banks have to those areas, insurance companies, again, investment pools. And until we know that, people tend to sell first and ask questions later.
Well, and it affects a lot of different companies as well. I mean, the Netflixes of the world or things like that have a stake in Russia. Maybe it's a small portion, but now investors are having to decide, okay, how much does this really affect their market share?
No question. So you have companies like Apple pulling out of Russia, Nike pulling out of Russia. There's this adverse effect as well. So the reality here's I'll tell you what what I like and what I don't like, okay? So what I like, and it's easier said than done, but we're finally getting some value back into the market. That will eventually be a good thing. I know it's hard to kind of fathom right now, but as stock prices and companies come down, right, there's going to be opportunity. And I think that's what we have to keep in the forefront of our mind. We're we are going to continue to pay our cell phone bill, and Apple's going to stay in business, and the bank you go to, and Kroger, and these companies are going to continue to stay in business. So as their stock prices come down, they become better value, and those are going to be buying opportunities in the near future. And that's what I like. Okay, that's a positive. We've been waiting for that for a long time. What I don't like is what we're seeing in this environment is, again, a lot of collateral damage. So JP Morgan, for instance, is absolutely getting, crushed, the stock itself. And why? Are you no longer banking at Chase? Are people no longer buying homes in the U.S.? No, that's not the case. That's still happening. What we're trying to determine is, does JP Morgan have exposure in Russia, Ukraine, or Europe? I mean, how much do they have? We know they have exposure. How much do they have? And that's true across all of these companies out there. Again, the other thing that is so again, it's uncertainty. The other thing is, we don't know how far this is going to escalate. Yesterday, in the middle of the night, we got news that Russians were shelling a nuclear plant in Ukraine, bigger than Chernobyl, and ultimately, at one point, it was on fire. I thought I was going to wake up to a nuclear meltdown, and that uncertainty alone is, again, why people are saying, get me out of this, etc. To the point, I mean, if you're a client of ours, odds are you got another a transaction saying, hey, we sold a little bit more. We still are looking to raise some cash in this environment, and it's hard to do. Prices are down, but despite our belief in emerging markets have become a very dangerous place right now because we don't know who's involved with what's going on overseas, and so we had to limit some of that exposure. So right now, we are in a protection mode and waiting for better opportunities down the road.
Yeah, and it seems like with everything that's gone on in the last 6 months, that another issue kind of overshadows a different one, but the one issue we've talked about continuously is the Fed. So how is all of this uncertainty kind of affecting what the Fed is doing?
Yeah, Jerome Powell came out the other day and basically said they're going to raise a 1/4 point in March. So he's eliminating some uncertainty. I like Jerome Powell. I really do. I think the Fed collectively is basically out to lunch, and they have been for years. But Jerome Powell is a businessman. He knows business. And he's, I think, realizing or knows he can't provide more uncertainty. He has to be certain. There has to be something that's certain. So I'm very happy he came out and said, look, in March, we're going to raise a 1/4 basis point. And there was speculation around 50, and there's Fed, governors, there are Fed presidents that are coming out and saying we need to do more. But he's saying we're data dependent, and we're going to raise a 1/4. If we weren't seeing this conflict in Europe, I think the market would have had a significant rally on that, just knowing, again, the certainty. But yeah, the Fed, COVID, they've taken a back seat. It's like we're not even talking about those things anymore. What's front and center right now is nuclear war, what's happening in Russia, Ukraine. Is NATO going to be involved? And obviously how that's impacting our markets.
So what can people, maybe even not our clients out there, do in this kind of time where it is so uncertain?
I always like to group people into 3 categories. You're young with a long time horizon. You do nothing different, right? It's the same basic principles. Make sure you are saving for your future through your 401k or 403b. You're not changing your allocation. You're dollar cost averaging. The irony is this group of people should enjoy the fact that the market's lower. I know nobody likes to lose money. I don't like to lose money. It's not fun. But this group of people, it's actually advantageous for you to be buying in at lower prices. That's important. Also, and I'll throw this in, debt reduction. So being fiscally responsible at home. I don't see the prices of our goods and services going down anytime soon. I do see certain things going down. I don't think used car prices are going to stay up at the prices they're at, etc. But our groceries, our utilities are going to stay elevated for a long time. That's much easier to handle if you have little to no debt, something we've talked about a long time. We did the webinars on this, for goodness sakes. The other group of people, whether you're a client or not, you're let's say closer to or in early stages of retirement. The critical importance there is that your allocation, I can't stress this enough. We've talked about this for years, but now we're in the middle of it, okay? Now we're in the fire. So we don't just we know it's coming, we know it's going to happen. Everybody knows that. Then we're in the middle of it and it's like, "Oh my, here it is." Step number 1 is your allocation appropriate. That's just simply the difference between your stocks and your bonds. Now, in this environment right now, other than trimming a little bit more like we're doing, difficult to make any brash changes, right? If you haven't done it yet, it's difficult to do right now, especially after a 10% decline in the S&P. But that's critical so that you know my appropriate allocation is this, I have time, I'm diversified, etc., and you stay the course.
Yeah.
I mean, you shouldn't, when during the turbulent times, you're not making significant adjustments. You just shouldn't be doing it. With the caveat, and I'll share this, the caveat of if it's wrecking your life, like if you're not sleeping at night and you're pacing and you're thinking, "Oh, the world is going to end, my financial portfolio," then yeah, you probably need to make some adjustments because we are 10% off highs, the S&P. If you're in a diversified portfolio, you're not that much off. And so making some adjustments is probably wise if you're not sleeping. The third group are later on retirees, distribution phase, living off of those resources. Number 1, you should have an appropriate allocation. All this stuff applies to you. But number 2, I will say that I do think it's important to be making sure what the assets you're in are able to weather this storm. So for example, whether we like it or not, whether, it is what it is, we reduced some further exposure. We've done that now. We did that in December. We did that in January, and we did it again the first week in March. I don't like doing that. I mean, it's not what I want to do. But in these areas in this time, I'm going, I don't like what I'm seeing here, and the risk versus reward is too high, and I reduced. Now, again, a majority of our clients are in that camp.
Right.
So that's what they're compensating us to do, is to make those decisions. But that's the 3 kind of groups of people. I will say this is not a time to go, "Oh, let's take the biggest risk we can and buy some defunct company," at all. I don't see that. I don't see, and I ironically, I hear it kind of murmuring out there a little bit with especially younger folks, "Well, let's just take a position in this or this." I don't see that right now as a wise decision.
Great. Well, do you want to give us an update on kind of, I know we've talked about it multiple times on these videos, but Blue Spring and that kind of thing before we end this up?
So real quick, I mean, if you're a client of ours, we've started to send out, we're well through the process now with Blue Spring, our new partner in what we're doing as a financial firm. We're very excited about that. As I've mentioned many times, we have to receive what's called a positive consent. So you have to say, "Yep, still want you as our advisor," and we're doing that electronically. We're mailing that out. You'll get an email from us about that, and you can electronically sign that, get it back to us, and then we'll probably never talk about it again.
Yeah,
we're moving on. So yeah, but I think in conclusion, let's talk about this. Markets are volatile. I mean, 2 years ago in 2020, you weren't here before your time, but 2020, 2 years almost to the day, markets are just careening lower with COVID. I'm working from home. The office was, basically shut down. The world was shut down, and we thought we would never. I'm telling you, there were many times I'm going, "How are we going to get through this?" Now I knew we could get through it. I always remained optimistic. We can get through this, but it was difficult. I will tell you, in the midst of rising oil prices, gas prices, nuclear war, invasion, divide in our country, we will eventually get through this, and we will be better for it. We will be stronger for it. And through it all, there's going to be some amazing opportunities. So we have to remain optimistic, kind of be smart about it, and just keep pushing forward.
Great. All right. Well, thank you all so much for tuning in again, and we hope you have a great rest of your week.
We'll see you next week.